Chapter 13, Part 1, Current Liabilities. Liabilities. Their characteristics, the ones we're talking about, well, actually it applies to all kinds, are future sacrifices of economic benefits, arise from present obligations, result from past transactions or events, recording current liabilities. We should be recorded at their present value when they're current. Except liabilities payable within 1 year, which are ordinarily recorded at maturity amounts. Interest calculation. Okay, remember, interest is due over time. So the day you sign something, you don't own the interest. It's only as you hold the money, you either earn or owe the interest. It's a return for using lender's money, stated in terms of a percentage rate to be applied to the face amount of the loan. The calculation is the face amount times the annual rate times the time to maturity. That's usually number of months. So remember, the face amount times interest equals your annual interest expense. If it's not for 12 months, then you have to take that into consideration and adjust for the actual number of months it's owed. So if it's 3 months, it would be 3/12. Now, an example. On September 30th, 2021, Mike Corporation got a short-term line of credit for $20 million. On October 1st, they issued a 9-month, 12% promissory note. So, what is going to be our journal entry on September 30th? Nothing, because you don't record a line of credit. You might put it in the notes of the financials, but because it's not owed until you actually draw on the line of credit. October 1st, you're going to record the notes payable. December 31st, you have to accrue 3 months of interest because 3 months have gone by. So remember, it's not the face of the note times the interest. It's the face of the note times the interest times the number of months that have gone by. When it's due, you're going to take the notes payable off the books. You're going to book the interest payable. You're going to book the additional interest expense for the 9 months, and then you're going to credit cash. Now, what happens if instead you pay the interest up front? This is called a discounted or non-interest bearing note. October 1st, September 30th, again, we don't do anything when we get the line of credit, but when we actually book the notes payable is going to be the face of the note. The discounted note is going to be the face of the note times the interest times the number of months, and that's going to be discounted note. And if you notice, you receive less cash because they're taking out the interest in advance. December 31st, we're going to accrue our 3 months worth of interest, and then when we pay it, we're going to pay the notes payable and the cash of $20 million and take the balance of the discounted notes off the books. Now, what's the difference in the interest rate if the interest is paid at the end versus paid at or deducted at the beginning, which is a discounted note? Well, interest charged if paid at the end was 9%, which is what we just did. Now, what about the interest charge if deducted at the beginning? Well, we had interest expense of $1.8 million, but we only received $18,200,000, so we actually paid almost 1% higher. So you always pay more for a discounted note. Now, liabilities from advance collections. We have advance collections, we have deposits, refundable or advances from customers, we have gift cards and collection for third parties. Now, let's look at an example of containers. In this example, what we have is people buy product, but it is in containers, and they are charged a deposit, and if they return it within 18 months, they get their money back. So, on January 1st, they had deposits on hand of $530,000. During the year, they collected an additional $850,000. They refunded $790,000, and they wrote off $35,000. were forfeited because the people kept it longer than 18 months. So, deposits collected would have been cash, liability refund, containers return, we'd take it out of the refund and credit cash, and then the forfeitures would be booked as revenue, but also taken at a cost of goods sold. And if you notice, the revenue matches the expense, so these are like a wash. And then the balance in the liability account would be $555,000. And we just add up your journal entries to figure that out. Now, what about gift cards? Okay, in this case, they sold $10,000 in gift cards in June, $15,000 in July. During the year, $6,000 of the June and $8,000 of the July were redeemed, and the cards are considered non-usable or broken after 6 months. What's our journal entries? Well, for the gift cards in June and for the gift cards in July, they're both booked as deferred revenue. Record redemption of June and July cards. We take in our deferred revenue and booked a revenue gift card. The December 31st expiration of the June balance of the June gift cards would be $4,000, which is the $10,000 we sold minus the $6,000 that were redeemed. So that would be that journal entry, and then the balance in the account would be $7,000. That includes part 1 of this 2-part presentation. That should help you with your homework. And if you have any questions, please email me.